From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for May 9th, 2025. Here's what's happening this weekend. The Brew Crew is on the road all week with Tampa and Cleveland before returning home for the Twins. This weekend, the Downtown Ghost Tour is waiting for you. And for something just a little more than freaky, it's the Cream City Cannibal Jeffrey Dahmer Walking Tour. I don't make these up. Let's start with even more weirdness. An Akron, Ohio woman was charged with multiple drug offenses after Chewy, her raccoon, was discovered in her car holding a meth pipe in its mouth. The cops also found cocaine and 3 more meth pipes. Sounds like Chewy has a problem. The cops' official response was, well, this is a first. Liam Fevers is a very generous 8-year-old boy. Without his mom's knowledge, he planned a carnival for his friends. He used Mom's Amazon account and ordered $4,000 worth of Dum Dum Suckers. Amazon delivered 22 cases this week, and there are more on the way. Mom said her son was just being friendly. I'm sure my mom would have had a completely different reaction. The latest fad for men in New Zealand is removing their eyelashes. Why? So there is no question of your masculinity. You've got to question their intelligence. And speaking of intelligence, or lack thereof, a tourist climbed into an enclosure at the zoo in the Philippines and was promptly bitten by a crocodile while taking a selfie. He thought the croc was fake. It wasn't. On the podcast today, we have Adam Baley, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A bit of a down week, but only slightly. The NASDAQ down 0.3%, down 49 points to close at 17,929. The S&P 500 down 0.5% this week. That's 27 points, closing on Friday at 5660. And the Dow Jones Industrial Average down 119 points on the day Friday, but just 68 for the week, down 0.2% to close at 41,249. On the year, Dow down 2.6%, the S&P down 3.4%, and the NASDAQ down 7%, all including dividends. You know, Adam, mostly quiet week, I would suggest. Not a lot of data out there, although the big thing in focus was the Federal Reserve. I think no real thought that we were going to get an interest rate cut. But as always, kind of looking to what are Jay Powell and the Fed saying about kind of the path forward. And again, I don't know that we learned much, but what are your takeaways from this week's Fed meeting?
Well, my takeaway is that it came in exactly in line with expectations. The Federal Reserve was widely expected to just leave steady rates, and they have. And they gave a press conference, essentially cited that they've continued to meet their goal on where the labor market should be. We still have a relatively strong labor market. But inflation pressures could percolate once more, especially if we get some tariff-induced inflation. So they left steady for now, realizing that if inflation does pick up, they are going to need the ability to change rates. Or if the economy slows due to a trade war, they're going to need to keep some dry powder so that they could lower rates down the road. They did not yet give any guidance at this meeting. Every other meeting, they give some guidance on where they think rates are going to go in terms of just how many rate cuts for the year. That will happen at the June meeting, but we didn't get anything new at this meeting.
You know, I think it's instructive sometimes looking at Jay Powell's remarks, and one in particular struck me this time, which was in kind of referencing some of the challenges that have come from the tariff and broader economic conversation. Powell said, it's really not at all clear what it is we should do. And I think, in one sense, I think we feel that very much right now, right? That there is this kind of cloud that's hanging over expectations for markets, for earnings, for the economy more broadly. And in the other, there is this expectation that, well, you're the expert. You better know what you should be doing. And I think Powell didn't say it to mean, hey, we don't have a plan here. What he said, what I think he meant in saying it, and again, maybe I'm reading too much into it, is that absent some data to the contrary, taking any action right now doesn't make sense. And I think that's what we've kind of counted on the Fed for, Adam, is, hey, be data dependent, not dependent on what the expectation of what you're going to do is.
Yeah, actually, I really appreciated hearing him say it's not yet clear what we should do. It was a moment of honesty from the chairman of the Fed. And it also kind of goes back to their long-term game plan and his MO and how they have acted, where they have been clear that they want to wait until all the data rolls in and that they have clarity on the direction. And then when they do, they act quickly. And that's how they did handle this coming out of 21 and 22. And that's how they're handling this time around, is they're waiting for clarity on the data and then act quickly.
I think we've always viewed the Fed's independence as kind of the critical piece, right? That they aren't going to just bend a knee to politicians or to something other than what is their dual mandate, stable prices and, job growth. That's reasonable. And I think as you look at, well, if they're saying we don't know what it is we'd be doing different right now, which again is kind of how I'm reading into it, I think it's telling you precisely that we're going to maintain our independence at a time when that has come into question, which I think, again, is what my hope is for the Fed, that they're going to continue to rely on the data. They're going to continue to rely on what they think is coming. When you look at what the market thinks more broadly, some signs that maybe we get 2 to 3 cuts, it gets harder and harder to get more than that the later you get in the year, because it's so it's so rare to get a cut bigger than just a quarter point, right? And so I think if we're looking at where our rates as we finish the year this year and kind of trying to prognosticate, well, the folks that thought maybe we'd get down to 3.25 or even 3 are probably out of the question now unless we see some pretty significant shift. And with a kind of overnight at a pretty happy place right now, again, sitting somewhere between 4.25 and 4.5, well, it would take a lot to really push rates significantly lower from there, which to my eye is a good thing, right? That for investors that are hoping to get a little more on cash or short-term high quality, well, 4.25 is a much bigger number than maybe where we thought we'd be.
Yeah, for one, the Federal Reserve's remarks are just kind of calming to the market in terms of retaining their independence. And then two, leaving rates where they are means you're still getting a competitive return on just holding cash. For all of the turbulence out there, you're getting paid to have patience to hold some cash in your account. And on top of that, you go out just a little bit further in high-quality, shorter-term bonds. You're getting paid, again, handsomely, somewhere between the 4 to 5% range on high-quality short-term bonds, somewhere around 4% on cash.
Adam, a big piece in the news this week was this conversation on tariffs and a potential deal being reached between the UK and the US. Clearly an easier deal than most probably to get done. We don't technically have anything signed yet, so I'm not sure it's fair to say that we've reached an agreement, only that in principle there are some things we've agreed on. But what does that maybe tell us about where some of this tariff conversation might be headed?
Well, there's more conversation to be had. That's what it tells us. I wouldn't go so far to say it was a trade deal, because no deal has been done. It is a trade announcement where both countries, both between us and the United Kingdom, are at least agreeing to discuss a possible framework of what a deal might look like. I guess UK was the most likely culprit to be the first. They are the lowest hanging fruit, in part because they have a sizable trade surplus with us. While the U.S. stock market did move modestly higher on the announcement, that was not the case for UK stocks. UK stocks were actually down after the announcement, perhaps signaling that we should at least temper our enthusiasm for a potential deal. The other piece of this is the bespoke nature of the deal that the UK has. That it leaves no clear path or roadmap for any other country to try to implement in this. So I guess my takeaway, at least we are attempting to make some sort of deals to alleviate some of the pain that we've had with the trade war and tariffs.
If anything, I think it speaks to just how hard it's going to be to get these deals done, because If this was the easy one, if it took us this long, and if there's this much nuance in the deal itself, as an example, when you look at some of the carve-outs from the tariff that's been agreed to, you have carve-outs for British vehicles being imported here into the U.S. Well, aren't a lot of those to begin with, but you add in that the biggest place most people go is Jaguar Land Rover. Well, Jaguar Land Rover is owned by an Indian company by the name of Tata, and a lot of their vehicles are manufactured in other parts of Europe. And so even making this deal with the UK regarding vehicles coming from the UK doesn't completely absolve the UK's manufacturing base from all these other pieces. And so, just in that one simple carve-out, you're missing all of the nuance that comes from global trade as it's currently constructed.
Yeah, it's interesting. You went to Land Rover and Jaguar. I'm a sports car guy. My first thought was Aston Martin. So to each their own.
Well, and Jaguar are not manufacturing vehicles presently and having some issues recently with some fire hazards on the road. So potentially you went to the right place there. Joel, a quiet week overall on the economic front. We get some of those cycles where a big week on, a big week off. Not a lot that stood out to me, save for, maybe some news on trade deficit, which we'd already kind of gotten in the first quarter GDP report.
That's right, yeah. We had the trade deficit number for March. It was a record $140.5 billion. It was 92% wider than it was the year before. Imports grew by 23% in that time, and a lot of that is what we were talking about last week. It's just the pull-through of companies importing things before they expected tariffs to go into place and things to cost more. But it made a big difference. We saw in the GDP report last week that that trade gap added almost 5 percentage points to what the GDP was. Without that, we wouldn't have had a negative number as far as the GDP actually going backward in the first quarter of the year.
Amazing to me just how significant these conversations really have been on the overall economic picture. And I think it's, I keep joking with clients, and it's the conversation we always had was you don't worry about the political piece as much because ultimately it's businesses, ultimately it's consumers that really drive the economic engine, and especially for stocks. And I think we are seeing more of a political impact in the recent data, and the GDP or the trade deficit number is a pretty good example of that.
Yeah, I mean, you look at coming into this year and the expectations for the Fed, and there were expectations that they were going to keep cutting rates right away. But the tariff policy is huge. It's a very disruptive policy. However it turns out, it's causing some short-term commotion, and that's why the Fed is waiting right now. They're seeing all these ripples, but they're not seeing a lot of hard evidence yet. And that's why they have to wait for more evidence. But we're hearing little reports. We're hearing Mattel saying that they're going to raise the price for dolls and that they're not going to do as much manufacturing in China. We're hearing McDonald's and Coors saying that their first quarter income isn't going to be as great because people are drinking less beer or eating out at McDonald's less.
How dare they drink less beer?
And then we have these very dramatic reports that we shared last week on consumer sentiment and consumer confidence. And the Fed's Chair Powell this week basically said, those aren't real. There's not a real strong relationship that we see between the consumer sentiment and confidence numbers and the things that we're looking for in the economy.
Yeah, I'll expand on that one. The consumer sentiment numbers they're squishy emotional numbers, and there's not a hard link between what consumers say and what they do with their wallets. Not always. You can go back to, say, 2022 or 2021 where sentiment was low at that point because inflation was high, but yet we were still getting out there and spending like it was going out of style. But at some point, you get such a collapse in consumer confidence, you have to ask the question, when does it begin to impact consumer spending? Haven't seen that yet, but it's something we're watching.
Right, and we're going to maybe see some of the McDonald's and Coors reports showing up in some of the other numbers that we see on consumer spending.
And I think one of the pieces I always point to is the fact that there is some base for spending regardless of how you feel, right? That you still need to eat, that you still need to put gas in the car, you still need to do some basic functions. And so what we're talking about is even when consumer sentiment is weak, not an entire collapse, but on the margins, are we seeing slight decreases in spending or increases in spending? And I think there is a tailwind to spending overall just based on demographics. We have a population that has aged, 4.5 million people turning 65 this year, 4.1 million turned 65 last year. And I'm going to tell you, when I talk to my clients that are in that phase of life, they have planned spending, not just the spending that they had locked themselves into because it was food and gas and all the others, but they also had trips that were on their mind, or home improvements that they wanted to finish, or other things. And so I think there is some element of, well, yeah, I don't feel great right now, but I had already planned to spend this, so I'm going to follow through.
Do you think there's less of a panic maybe in people who are retired and they've got a set amount of money that they're looking at that, I'm getting some cash flow from there?
That's my hope, right, is that they have a good enough plan that they aren't worried when things look a little worse, and they're not going overboard when things look a little better, because the plan accounted for the fact that things were going to ebb and flow. I'm not sure that's always true, especially for new retirees. I think there is some nervousness to that transition. But I also know that there's plenty of folks that have more than enough. And there's plenty of folks that are looking at retirement and going, well, okay, it's not great. It's not what I was precisely thinking I was entering, but it's going to get done. Anything else, Joel, that stood out from you on the economic front this week? ISM Services was the other one I had kind of circled, just because the Institute for Supply Chain Management is always kind of a way we can look ahead sometimes.
Right. Yeah, and
at what do we think is coming next?
And those are more recent figures. They survey the supply managers from all over the country, and that's a pretty good sign of what the biggest part of our economy is doing, the service sector. And that showed expansion for the 56th time in 59 months. So that's pretty good. But there, too, some of those managers were saying that they were seeing pricing impacts from tariffs. They were saying that they were seeing federal cuts in spending, the federal government spending less money as a draw on their business, dragging down their business. So those are things that, again, it's more of a survey-based indicator, but maybe it'll show up in harder evidence later on.
And it's also one of those things that does impact earnings down the road, where if your input costs are higher and you're selling less, that impacts earnings and margins. And long term, the only thing that the market cares about really is interest rates and earnings. And interest rates still historically low. 10-year Treasury is about 4.3%, give or take. And corporate earnings, when we started this year, could have been as high as 15%. That's got walked back pretty quickly to 12, and then now 10-ish. And I've seen some bookends between, say, 5 and 10, but I think 10 is a fair estimate for what we see now. We still have historically low interest rates and modestly expected rising profits, so still some potential for room to run, but we're definitely going to have a lot of volatility.
And Adam, getting back to the whole point of what we were talking about before about the Fed, the more those profits get pinched, the more likely companies will be laying off people, and then the unemployment rate will go up, and then the Fed will get more concerned about that side of what they're trying to do.
All these things are interconnected.
They are, and I think as we look at kind of the end of an earnings season here in the next week or so, about 10% of the S&P 500 left to report. I've been looking ahead to kind of what valuations look like on the stock market, especially with the recovery we've seen since the market lows. Starting to get a little pricey again, although as I was updating some of those numbers, I went back to where's the S&P been over the last 5 years or over the last 10 years, and the averages have started to come up pretty significantly as well when you look at, all right, what are we paying for the next 12 months worth of earnings? Right now, almost 21 times forward earnings. The last 5 years, it's been close to 20. So not as expensive, maybe, especially relative to recent history, as what we've been saying for a while. Again, I think it means that you got to be a little bit more cognizant of, is that number 10 or is it 5, as you said, Adam, here, if those are kind of the outsized potential earnings numbers. But either way, it isn't so overpriced that you should really need to worry that we're going to get this massive correction simply from gravity alone, simply from the fact that stocks have to come back to some more normal multiple. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.